There is a moment in every financial crisis when it stops being a warning and becomes a fact. A moment when the system doesn't look broken yet, but it already is. According to the narrative you've been told, the next crisis is somewhere in the future. A recession. A slowdown. A soft landing, maybe a hard one, but still manageable. That narrative is wrong. We are not approaching the next financial crisis. We are already inside it. What makes this moment different isn't fear, panic, or headlines. It's timing. It's structure. It's mathematics. In 2008, the system broke because of excess risk in one sector, housing. In 2026, the system breaks because everything is overloaded at once. Corporate debt, banks, shadow lenders, commercial real estate, insurance companies, government finances, and the central bank that is supposed to hold it all together. This time there is no single villain. No isolated bubble to pop and move on from. Every major pillar of the system is connected, and every one of them is under strain. For more than a decade, cheap money masked fundamental weaknesses. Low interest rates turned bad balance sheets into manageable ones. Refinancing replaced repayment. Liquidity replaced solvency. And risk didn't disappear, it just moved. Now the conditions that held this structure together are reversing. Not slowly, not gradually, but all at once. Interest rates are higher. Liquidity is thinner. Asset values are falling. And the debts that were never meant to be paid back are finally coming due. What's coming in 2026 is not a shock. It's not a surprise. It's not even a prediction. It's the inevitable result of decisions already made, loans already issued, and promises that can no longer be honored under today's conditions. The dominoes are already standing. The push has already happened. Most people just haven't noticed the movement yet. And it all starts with one wall, a wall the entire system has been trying not to look at. The refinancing wall. Every financial collapse has a trigger. Not the cause, the trigger. In this cycle, that trigger has a name. The refinancing wall. Between 2020 and 2022, interest rates were pushed to near zero. Money was cheap, abundant, and everywhere. And corporate America responded the only way it ever does in that environment. It borrowed. Not cautiously. Not selectively. But at a scale never seen before. Companies issued bonds. They took out leveraged loans. They refinanced old debt not to reduce it but to expand it. Because when money costs almost nothing, debt stops feeling dangerous. For a while it worked. At rates of 4 or 5%, even weak companies could survive. Cash flow didn't need to be strong, it just needed to exist. Losses could be rolled forward. Mistakes could be postponed. But debt has a clock. And in 2026, that clock expires. Hundreds of billions of dollars in corporate debt reach maturity in the same narrow window. Debt issued in a zero-rate world must now be refinanced in a high-rate one. This is where the math breaks. A company that borrowed at 5% is not just paying a little more at 9 or 10. Its entire financial model changes. Interest costs double. Margins disappear. Cash flow turns negative. What once looked like a healthy business suddenly becomes unviable, not because demand collapsed but because the cost of money did. Some companies will survive. The strongest ones. Those with real profits, low leverage, and predictable revenue. But the system isn't built on those companies. It's built on the marginal ones. The ones that relied on cheap debt to stay afloat. The ones that refinanced instead of fixing underlying problems. Those companies don't get a second chance. And when they fail, they don't fail quietly. They default. And defaults don't stop at the company level. They move outward, to the institutions that funded them. Which brings us to the next problem. Because the lenders holding this risk are no longer the banks you think they are. For most people, the word lender still means a bank. A regulated institution. Deposits. Capital requirements. Government backstops. But that picture is outdated. Over the last 15 years, the center of gravity in American finance quietly shifted. While traditional banks were being regulated, restricted, and forced to hold more capital, a parallel system grew in their shadow. Private credit funds. Leveraged loan vehicles. Structured credit products. Together, they became the new engine of corporate lending. When banks stepped back, they stepped in. When bond markets hesitated, they provided capital. They became the lenders of last resort for riskier companies, not because it was safe but because it was profitable. And for years it worked. Low interest rates covered mistakes. Rising asset prices masked losses. Defaults stayed low, not because businesses were strong but because refinancing was always available. But here's the critical difference. Traditional banks have safety nets. Shadow lenders don't. They don't have deposit insurance. They don't have guaranteed access to emergency liquidity. They don't have regulators standing ready to stabilize them in a crisis. Their funding depends on confidence. And confidence is fragile. As 2026 approaches, that confidence is already starting to crack. Investors are pulling money out. Redemptions are rising. New lending is slowing. The same institutions that absorbed risk during the boom are now trying to reduce it, at the exact moment the system needs them the most. This creates a dangerous mismatch. Companies need to refinance hundreds of billions in debt. But the lenders capable of taking that risk are stepping away. When supply disappears in credit markets, prices don't adjust smoothly. They gap. Interest rates spike. Financing terms harden. And for many companies, refinancing simply stops being an option. This is how a liquidity problem becomes a solvency crisis. Not all at once, but fast enough that no one has time to react. And while attention stays focused on corporate debt, another sector, even larger, even more fragile, is quietly reaching its breaking point. Commercial real estate. For the past 2 years, commercial real estate has been bleeding. Slowly. Quietly. Mostly out of sight. On the surface, the market still looks functional. Buildings haven't collapsed. Banks haven't written off losses at scale. Headlines talk about temporary adjustments. But the reality underneath is very different. Office buildings across the United States are sitting half empty. Not because of a short-term shock, but because of a permanent shift in how work is done. Remote and hybrid work didn't fade. They stuck. And that structural change broke the math that commercial real estate was built on. These buildings were financed on assumptions that no longer hold. High occupancy, stable rents, predictable cash flows. When a building goes from 90% occupied to 50%, it doesn't become less profitable. It becomes unviable. The debt doesn't shrink just because demand does. And now that debt is coming due. Over the next 18 months, hundreds of billions of dollars in commercial real estate loans must be refinanced. At higher rates. Against lower property values. With weaker cash flows. For many properties, refinancing isn't difficult. It's impossible. This is where the losses move from theory to reality. When loans can't be refinanced, they default. When they default, properties get handed back to lenders, often at fractions of their original value. And here's the problem. For many regional banks, commercial real estate isn't a side business. It's the core of their loan books. Some of these institutions have 30, 40, even 50% of their assets tied to commercial property. They look stable, until those assets are marked to market. We've already seen the preview. Banks that appeared conservative collapsed not because of reckless lending, but because rising rates revealed losses that had been hidden on their balance sheets. What's coming next is larger. When commercial real estate losses are finally recognized at scale, they won't stay contained within a single sector. They will spread. From borrowers to banks. From banks to insurers. From insurers to pension funds. This is where isolated failures turn into a system-wide problem. And this is where the feedback loops begin. Financial crises don't spread because of panic. They spread because of connections. Every major institution in the system is linked, through balance sheets, collateral, guarantees, and assumptions that only work in stable conditions. When one part weakens, the strain transfers instantly to the others. This is where the damage accelerates. As corporate defaults rise, lenders take losses. As lenders take losses, capital buffers shrink. As capital shrinks, lending tightens further. That tightening pushes more companies into distress. It's a loop, and once it starts, it feeds on itself. Banks respond by protecting liquidity. They reduce exposure. They stop rolling over loans. They sell assets into falling markets. Asset sales push prices lower. Lower prices force more write-downs. More write-downs trigger margin calls and covenant breaches. At the same time, insurance companies and pension funds begin to feel the pressure. These institutions aren't passive observers. They are major holders of corporate bonds, structured credit, and commercial real estate exposure. When asset values fall, their portfolios suffer. But unlike hedge funds, they can't simply wait it out. They have obligations, insurance claims, guaranteed returns, retirement payments. Losses that look manageable on paper quickly become solvency issues in reality. And once doubts about solvency appear, behavior changes. Counterparties pull back. Credit ratings are downgraded. Funding costs rise, or disappear altogether. What started as a corporate refinancing problem becomes a confidence crisis across the entire financial system. This is the point where authorities usually step in. Liquidity injections. emergency programs, rate cuts. But this time the tools that worked before are either weakened or gone. Which brings us to the most dangerous assumption of all. That the government and the Federal Reserve can simply save the system again. Every modern financial crisis ends the same way. When markets break, the government steps in. When liquidity disappears, the Federal Reserve provides it. When institutions fail, they are absorbed, rescued, or backstopped. That playbook worked in 2008. It worked again in 2020. And that's exactly why it may not work anymore. Because every time it was used, it came at a cost. Today, the U.S. government is carrying debt levels never seen outside of wartime. Interest payments alone are approaching levels that rival the largest federal programs. And those payments are rising, not because spending exploded but because old, cheap debt is being replaced with new, expensive debt. The Federal Reserve faces a different constraint. In past crises, it could cut rates aggressively without consequence. Inflation wasn't a threat. Confidence in the currency was intact. That's no longer the case. The inflation surge of recent years exposed the limit of money creation. It showed what happens when liquidity stops being absorbed by markets and starts showing up in prices. The Fed tried to restore credibility by tightening policy, by raising rates, by shrinking its balance sheet. But the underlying structure didn't heal. It just became more fragile. Now imagine the choice the Fed faces when the next wave of failures begins. Create more money to stabilize markets, and risk a loss of confidence in the dollar. Or refuse to intervene, and allow a deflationary collapse as credit evaporates. There is no painless option. Bailouts risk a currency crisis. Non-intervention risks a systemic implosion. And unlike 2008, there is no clean balance sheet to absorb the shock. The government is already running large deficits in a non-recessionary environment. The central bank is already under political and economic pressure. The institutions that once stabilized the system are now part of the problem. Which means the final stage of this crisis won't just be financial. It will be global. When people think about financial crises, they imagine them as national events. A recession here. A banking problem there. But this one doesn't stop at borders. Because the dollar isn't just America's currency. It's the backbone of the global financial system. Global trade is priced in dollars. Debt around the world is issued in dollars. Central banks hold dollars as reserves because they trust the system behind it. That trust is the final pillar. And it's being tested. As debt grows and confidence erodes, investors don't need to believe the United States will default. They only need to believe that the purchasing power of the currency will keep falling. When that belief takes hold, yields rise. Borrowing becomes more expensive. Debt servicing crowds out everything else. That's how a debt problem becomes a debt spiral. At the same time, geopolitical rivals are watching closely. Preparing alternatives. Reducing exposure. Waiting for an opening. A financial crisis at the core of the dollar system doesn't just reshape markets. It reshapes power. The ability to run deficits. To export inflation. To finance stability by issuing the world's reserve currency. Those privileges don't disappear overnight. But they don't disappear slowly either. History shows they vanish in moments of stress, when confidence breaks faster than policy can react. And that's what makes 2026 different. This isn't about fear. It isn't about speculation. It isn't even about prediction. It's about structure. Too much debt. Too little margin for error. Too many interconnected institutions relying on conditions that no longer exist. Corporate debt. Shadow banking. Commercial real estate. Insurance balance sheets. Government deficits. Central bank constraints. They are not isolated risks. They are one system. And when one part gives way, the rest doesn't follow politely. It collapses together. The dominoes are already in motion. The timeline is tightening. And the outcome is being shaped right now, whether most people see it or not. If you want to understand these moments before they happen, not through headlines, not through hype, but through structure, history, and incentives, this is exactly what we document here. This is Finance Archives. If this perspective helped you see the system more clearly, subscribe. Because the most important financial events are never obvious while they're unfolding. They only look obvious in retrospect. And by then it's already too late.